For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, and we'll talk about the beginning of the year and end of the year financial tasks to be aware of. Also, cash flow or income, which is more important? And finally, investment and withdrawal strategies to not run out of money in retirement. My name's Jeff Shade, but as always, I'm just here to ask the questions. You know the words of wisdom and solid advice. They come from Randy and Jake Floyd of Floyd Financial Group. But I'll start with you, Randy. Good morning. How are you?
Doing very well, Jeff. How about you?
I'm doing great, thank you, now that I'm with you guys on the radio. Hey, Jake, how's this Saturday morning treating you, my friend?
Doing great, Jeff. Thanks for asking.
Always glad to hear it. We certainly appreciate you making us a part of your weekend. Okay, guys, let's start with current events. First thing I want to talk about, jobs report. What happened here with the jobs report?
So the jobs report was a little lackluster. After December, it was revised. We thought we had 350,000 new jobs in December of 2024. And then we came back and they revised it to around 300, but that's to be expected with the holidays and things. But when it came in at 143,000, people were like it was a pretty low number. I mean, unemployment, after all, is still 4%. And, we are maintaining on several fronts. If we look at how continuing claims for unemployment are running, they've been running the 1.8 million gamut all through there. We're still, nearly historic lows in unemployment. So, maybe the jobs were a little bit lackluster in January. That's still pretty healthy for January. And I think we will see there's going to be some adjustment as Trump comes into office and things are getting, how would I say that? The puzzle is being recut.
Okay.
Right? And so I think we may see some lower jobs numbers early on, but long term, we're going to see very, very good numbers on the jobs front.
Randy, why is the jobs report number important to us? Why do we talk about this? What does it mean to the market and the economy?
Sure. Well, if you're creating new jobs, that means economies are growing and your overall pie is getting bigger here in the U.S. So that's the thing that I know Trump wants to do and is going to do. We'll talk about, tariffs and things here a little bit later in the program. But one of the things that has kind of been interesting as we watch this is everybody said, man, you can't do these tariffs. All it's going to do is raise prices and create inflation. And really what we're seeing is in every case, these countries cannot afford to not do business with us, and most of them are caving.
You can't do tariffs, all we're going to do is win and keep winning. That's what they should be saying, because that's exactly what's been happening. So I think, anybody paying attention understands that, including, even some of these left-leaning polls that are coming back with 50 and 60% approval ratings,
right?
Which means he's probably got more like 70 or 80% approval ratings in real time. It's clearly working. People are like, tariffs don't work, and everybody hates President Trump. Did you watch the Super Bowl when they were singing the national anthem and he's saluting the flag and the entire stadium erupted? Like, it was twice the ovation that anybody else got on the field all night long. Yep. Certainly better than the reception that Taylor Swift got, I might add.
Oh, yeah.
That wouldn't be difficult, though.
No.
But yeah, tariffs are definitely having the desired effect by and large. Remains to be seen long term whether that's going to continue to be the case. But so far, I think we're getting a lot of things accomplished here.
Randy, you made a good analogy about tariffs before we went on the air. Could you explain that or maybe share it with our listeners?
Yeah, I think in general terms, and to make it really pretty simple, we're 4% of the world's population, and we use 25% of the world's goods here. So if you're a country looking to do business and 25% of the market is in the good old USA, how can you afford not to do business? Especially because if you look at China right now, their economy's on the ropes already. How can they afford not to do business with us? They can't. Europe's in decline right now. Everywhere you look, it's the same thing. And this is the continual moving target that we see whenever we do retirement planning. One of the things that I kind of love about what we do on this radio show. Now, there's, as you know, Jeff, there are lots of radio shows on the radio, right, that talk about finance.
Mm-hmm.
Most of them, if you listened every week, what would you hear?
Pretty much the same thing over and over again.
Exactly the same thing.
Yeah.
So here's the deal. Why do we take time to do this? Well, the issues of the day are important.
Right.
You know, clients' needs are unique. When we look at it at the political landscape, as we look at what's going on with inflation, with taxes, with regulation, all these different things, the idea that, you know, at some point there has to be some performance somewhere, right? So when we look at really basic financial planning, where does the performance come from? Where's the hope or performance? That might be called speculation in some cases,
Yeah.
you know. What is the client sentiment at the time? What's the sentiment of the country at the time? That changes everything. You know, when we look at current events, we're doing it not just so we can hear ourselves talk. We're doing it to kind of give people on the front end of the show a little bit of an idea of what's happening and some things and some points, as one guy said, they might want to ponder as they're thinking and watching the news, you know, and it's something that we're doing every day. And all these things parlay to make an economy and a retirement outcome for the income of our retirees.
Talking with Randy and Jake Floyd Financial Group. Our program, of course, is called Show Me the Money. Well, let's continue to talk about Donald Trump. 53% positive approval rating. That is after 2 weeks. And again, Jake, you're saying that maybe that is a little bit low because the source of the 53% is a rather left-leaning source.
Well, yeah, it's CBS and YouGov, which is not as bad as if it was, you know, ABC or CNN or something, but it's still going to be leaning left. I don't know. I really think that the overall sentiment of people, if you're out in the world, you go to Walmart, you go to the gas station and things, I think people are generally happier than they were 2 or 3 months ago. And I think that there's less anxiety about these situations. And I think that regardless of whether people voted for Donald Trump, I think they can't help but have this little sense of pride in their nation for the first time in quite a long time. And I think that's going to continue. I think Europe has been saying a lot of things about potential tariffs and things like that. We'll see how all that shakes out. But to Randy's point, these people cannot afford to draw a hard line. They can talk real tough and everything like the Colombian president did and Mexico did. And then when it really comes down to it, they're like, please don't crush us with your boot. And so Trump is not demanding anything that is unfair. We're simply asking that they pay their fair share of different items. And if they're going to have tariffs on us for the last 50 years in a lot of cases, then we're going to start protecting American interests.
Yeah. Well, our biggest trading partners, all of them, charge us more tariff than we charge them from the get-go. Yeah. That's important. People understand that. Right. It's not like this is a novel idea to, just go out and tax people. It's been happening since the beginning of time. And yes, free trade is good, but let me tell you that at the end of the day, everybody has to protect their own self-interest. And a fair deal is all we really want. We don't want a big advantage. We just want a fair deal.
Exactly. It's not like we're out here bullying these people, although we easily could.
Right.
That is not what's happening here. We're just asking that they help us protect our border, pay their fair share, and especially if they're going to be tariffing us to death.
Here's something I've been waiting for as well, too. If you're like me, I think most people have a little thing in the middle of their car there. They put their change in it. But for me, the pennies seem to be taking over there. There are more pennies than anything else I'm not using. And Donald Trump has ordered the U.S. Treasury to stop minting pennies. That sounds like a pretty good idea to me. Why do we need pennies, guys?
My question would be why didn't we stop minting them 20 years ago or something, at least 15 years ago, right? I think pennies have been obsolete and kind of a pain in the butt for a long time. But, to his point, it's basic common sense. It costs more than 2 cents to mint a penny that's 1 cent in value. That makes no sense whatsoever. No pun intended. But
that's right. The other thing to think about here is, growing up, everybody would bend over to pick a penny or whatever. I'm not sure it's worth the wear and tear on your back anymore. No. Bend over to pick up a penny.
Go to vacuum your car, you see a penny, you throw that one in the trash there. I mean, but Europeans come to this country and they see things are like $1.89, and then but they go to pay for it and it's like, $2.03 or something. Why do we need pennies? Why do we have to add the tax? I think it would be a good idea to include the tax in the price and just say, okay, this is $2.03. I've always wondered about that, guys.
I think it's just so we can be good at math. We need to be working on that sort of thing, Jeff. So if it's $1.89, how much is it really going to be? Well, if it's in Branson, it's $2.50 after tourist tax.
Oh, exactly. I forgot about the tourist tax. Yeah, I think it would make the McDonald's drive-thru grow faster if they didn't have to count in there.
This reminds me of a story that a guy told me one time. It's a little bit off color. This guy walks into the men's room, and he's there at the urinal thing. He looks down there, and he sees a dime and a nickel down in there. He looks and he thinks about it. He contemplates it for a minute. He reaches in his pocket and throws in another dime and says, for 15 cents, no, but for a quarter, heck yeah.
I like that.
I think it's going to take a lot more than that for me to be reaching in there.
Yeah, I would think so, too.
I think so, too.
But anyway, our audience is chuckling, and that's something that the other financial shows don't make you do. Talking with Randy and Jake of Floyd Financial Group. Let's wrap it up here by talking about gold continues to hit a fresh record high. Is a market correction looming? So I think gold is like somewhere around $2,900 an ounce. That is almost a record, if not a record. So why is gold going up like this? What does it mean?
The reason gold's going up a lot is really two things. Number one, it's kind of been due to go up. You know, it's been suppressed by big banks and other things that are controlling the gold and silver markets. But ultimately, the reason it's going up right now is inflation expectations. Mm-hmm. People are not convinced that we have beaten inflation and that we're going to keep it under control. And if you think that inflation is going to run rampant, then gold is a good thing to hold there because it will offset that inflation. And so that's really the big reason why since 2022, gold's been on such a big run. However, I'm not sure that they're correct. I think the case can be made either direction right now on interest rates and interest rate policy. Even the probabilities out on the FedWatch CME site are showing that the most likely path is that we cut in June and then we raise in December and then we cut again next June. And so like the market is really torn on which way this is going to go. And as I've said before on this show, it's really going to come down to oil prices, which is part of the whole thing with tariffs in Canada and all that. Trump is trying to incentivize domestic oil production. And I do think he's going to get that done. The question is whether it's going to take a month or a year or his whole term to make it happen. Personally, I think it's going to be somewhere between the first two. But if he's able to get inflation under control, and the key to that is drilling for oil, then gold could be in for a quite large correction, in my opinion. We'll see what happens. But I also think as cryptocurrency gets its legs under it, that's also going to be a headwind for gold.
Right.
And, you know, a lot of the big banks and the developed world has stayed away from crypto because it's kind of the Wild West. We're about to develop a framework for dealing with cryptocurrency, what's legal, what's not legal, and all that. And I think you're going to see all these huge banks start jumping in with both feet on the back of that. So I think that will be a reason for some of these big banks to sell gold and silver and buy into cryptocurrency, Bitcoin, those types of things. So if I had the crystal ball, or if you're asking me what I think that gold is probably about played out this run. I've been wrong on gold in the past, so that doesn't necessarily mean anything, but it does feel stretched here.
Well, if our listeners have questions about gold or silver, or they have questions about crypto, or if they've just enjoyed this robust conversation here for the last 15 minutes or so, and they would like to sit down with you, Jake, or Randy there at Floyd Financial Group, maybe Randy's got another joke for them, call this number right now, 417-889-7233, and request your Floyd Financial Group retirement review. Entirely complimentary, no cost, no obligation, certainly no judgment. You can make that call this weekend. Again, it's not going to cost you a dime. 417-889-7233. Make that call. Ashley will give you a buzz back during the week and set up a time that is convenient for you to come in and sit down and talk with the boys here at Floyd Financial Group. 417-889-7233, and check us out on the web at floydfinancialgroup.com. Time for a break, Randy and Jake. When we come back, we're going to be talking about beginning of the year financial tasks and also end of the year tasks and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about beginning of the year financial planning tasks that you maybe didn't even know you should be doing.
Right, and there's end of the year financial planning tasks as well, too. Well, the beginning of the year right now is obvious, but the end of the year in financial planning really is around October. Don't come to us in the middle of December because it may be too late to do some of the things that you want to do. But
Right.
Here we are in early February. So, Randy, what are some of the things that we should be looking at this point in the year that we might have some time to adjust if needed?
I think number one, first and foremost, and this is for everybody listening, whether you're 16 or you're 86, and that is, what are your financial goals for the year? What are you trying to accomplish? What are you planning to accomplish? And write those things down. You know, I grew up, Jeff, in the 80s in corporate business, and one of the things that we always had to do at the beginning of the years, we had a huge, what we called kickoff meeting. And the kickoff meeting was, this is what we did last year, but that is gone. What are you going to do for me this year? It's what always came up.
Right.
And it was one of those things we knew that goals and controls and review and tracking those goals made the outcomes what we wanted. So I think if people have not really sat down, and especially, you know, if you're 50 or you're 40, maybe you're 10 years out from retirement, what are your goals? Do you have some specific goals? Because if you don't, it's kind of like taking a trip and not knowing which direction it is to your destination, but thinking we'll eventually get there.
Right. You may not go in the most efficient manner, but eventually you'll get there. Now, when you say setting financial goals, obviously we want to set them for this year. They can be things such as, I want to increase my savings. I want to pay off my debt. I want to maybe put some money away for a car, that sort of thing. But do you recommend not only doing goals for this year, Randy, but also is it too much to say, this is what I want to do 2 years, 3 years, 4 years, 5 years out?
No, it's not at all. In fact, I think you should be looking at that. In fact, if you really want to look at this, let's say you're listening to this show today, and let's say you're 50 years old,
right?
And you're saying, you know what, I got 15 years to work. How do I know if I'm on track? Well, number one, let's sit down and let's look at what you've saved. Number two, let's talk about what's your current budget. Number three, what may be paid off that will not be included in that budget when you get there? Maybe a house paid off, maybe it's a farm or something like that. What's not going to be there, and what cash flow will I not need then? Let's subtract those dollars out. Let's adjust for inflation then from where we are today based on maybe a 3% rule each year looking forward. Let's see where we are, and let's reverse engineer the plan. Now, I don't expect people to do all this stuff on their own. That's why Jake and I have jobs here. We help people get through this and do this, and we've done it thousands of times now. And so is it a pretty simple concept? Yeah, once you've been through it, but the beginning part of it is, what's the list of items that I need to think about, and what's going to affect those, and how do we really put that out there? Well, how much money am I going to need to live the way I want to? What do I want to do in retirement? And again, these things may change as you age and you go along. They probably will, but you've got to have a starting point, or you may not end up where you want to go. You may end up in Bradleyville rather than Chicago.
Bradleyville, not a bad town. We love Bradleyville. It's the birthplace of Randy Floyd. So we want to set up financial goals. Certainly that's important. A lot of people listening to the program today say, well, I'm old enough, I'm mature enough, I don't need a budget. How important is a budget? Should everybody, once in a while, if not every month, make a budget and try to stick to it?
So the issue we have, Jeff, is as we age in this country, we tend to make more money. We get our families raised. We get all the college debts paid off, we hope, knock on wood. We get our house paid off and we get out of debt. And so we didn't really have to live on a budget like we did in the beginning. I remember going to the store with my wife, and we would carry the little calculator in our pocket. And we would say, do we really need that? Okay, let's take that off, and I'd like to have this. How about you? Yeah, let's get that one.
So it was like that opening scene on My Cousin Vinny where they're at the thing. He was looking at beans and marketing. 43 cents, 42, 41 cents. He's like, maybe it's worth an extra penny. But man, I remember those days. And back when we were going to the grocery store, then was it $30 or $35 that we got to spend?
Oh, yeah.
I remember early on in my career when I was in the food business, I used to travel a lot. Now get this will blow people's minds on this, but I used to drive 900 miles a week. I had a little car called a Renault Alliance.
I remember that. I'm surprised you got to where you were going in that Renault.
And so it was like, it'd get 30 miles to a gallon.
Yeah.
But here's the thing. I would put $30 a week in a separate checking account
Oh my
that I
gosh.
had that was my budget to buy fuel and eat on for the week.
Wow.
$30.
$30.
The reason Lisa set that up in the beginning was because she knew that way I would not overspend, because she put that money over there and I was never to breach that budget, right?
A lot of gas station hot dogs probably back in those
Oh, yeah,
days.
absolutely. And a bunch of Lance crackers, cheese
Oh, yeah.
crackers.
And you ate them in the car when you were on your way to the next appointment, too.
Absolutely.
Renault
Yeah.
Alliance, I remember the car well. It's a French car. They're still out there as collectible cars, not considered to be the most reliable. So maybe you did get a good one there, Randy. Set financial goals, create or review your budget. Next one's going to be review your investments. We should be doing that once a year, Randy, to sort of, what would you say, maybe boost the good ones and harvest the ones that are not doing so well?
So that's kind of a loaded question. Yeah, depending on the age that you are will determine how often you really need to review that. Not that you don't, if you're 35 or 40, just forget it. But I would say this, that, when you're young and you're trying to build your nest egg, you need to be more aggressive than you are. Maybe by the time you hit 55, you need to be kind of weighing and measuring a little more how your investments are working for you, what the potential for a downturn is. But again, if your time horizon is 5 or 10 years, you can be a little more aggressive. But we want to be sure that we match your portfolio with what you can stand mentally, physically, emotionally, and fiscally, meaning actual dollars and cents. So that's one of the things also that we can help people to kind of walk through here and measure and figure out, parse out, if you will, the risk versus reward profile of people.
So here in the beginning of February, we're considering this the beginning of the year because the holidays are finally over, and now we can settle in. At least hopefully we've settled into a routine here in February. We're going to set financial goals, create our budget, review our investments. Of course, we always want to update our savings plan, determine how much to save for retirement, emergency funds, major expenses. But I think one of the most important things that we can be aware of this time of the year, actually all year long, is going to be tax planning. What can we do insofar as tax planning to make an effect on our tax bill here in February?
It's funny that you bring that up, because a lot of tax accountants, people will come in, they'll bring a box or an envelope full of receipts, and they'll put them on the desk and they'll say, be gentle.
Be gentle. I've heard that one.
The bottom line is this. That's a foregone conclusion. You're just waiting for what the number is, right?
Sure, yeah.
So the tax planning thing is crucial to look at, to know, do I need to fund more into my 401k? If you're a retiree and you've been working a long time and you're 50 or older, you have special guidelines that you get to put more into your retirement account, which might help you reduce and not pay needless taxes. So there's always this balance between, do I fund this to a Roth IRA? Do I fund this to a traditional IRA? Do I put it in my 401k? Do I fund an IRA this year outside of my 401k or not, depending on what my income stream is? All these things are, well, it depends on the year that you've had at work and how much money you've made as to what the right answer to those questions would be.
So these are beginning of the year financial tasks, and I want to get to the end of the year tasks, so I'm going to basically just run down some of the rest of them here. Update insurance coverage. Take a look at the coverage that you've got right now. Consider an umbrella policy if you need that to cover the things that your regular insurance does not cover. Of course, I check my credit reports at least once a month. 3 of them, there's Experian, Equifax, also TransUnion. You can get an annual credit report for free, or you can subscribe to do those. Always a good idea to see where you stand there, to see if anybody's hacked into your accounts at all. Automating savings and investments, I think, is very, very important. If you don't see it, you won't spend it. So, set up some automatic contributions to savings and retirement accounts. Review your estate plan. Update your wills, trust, beneficiary designations, and plan for the major expenses. If you need, a new roof or you need a new car this year, you got to plan for those. So, end of the year financial planning tasks. Now, I want to point out that end of the year is not December 15th. How would you describe as a financial planner end of the year?
So here's the thing. If you're a business owner and you're one of those folks that has situations and, maybe you're a home builder and you sell 3 houses in the first quarter, maybe that's more than you would normally sell and you have a lot more profit. You may want to go ahead and do a little calculation there and set some money aside for taxes. There's just a lot of things you need to consider. Maybe you need to make one of your major contributions to a retirement plan or to a savings account or to your vacation plan or your Christmas fund or whatever it is. So, as the year goes along, it's not just year end. We need to be thinking about, okay, yeah, ultimately we're thinking about what is the year end going to look like. But it can be very different each year if you're a business owner. Now, if you're on a salary, if you work by the hour, that may not change much until the end of the year, but maybe you have a bonus that comes in or something like that. But I would just say that the end of the year, trying to get things cleaned up and really look at what all your options are, you probably want to start in September or October to really know what's going on.
Yeah, because in December, you're going to be busy with holiday things. And for financial planners and particularly CPAs, October 15th is good because finally we've got those extended tax deadlines that we're done with. I think that's a very good time to make end-of-year plans. So put that on your calendar, is around the middle to the end of October. Also, you want to use your flexible spending accounts, your FSAs, review your tax loss harvesting. As far as charitable contributions go, should we be looking at those in October, and do charitable contributions really mean as much fiscally or money-wise as they used to because of the standard deduction?
Yeah, that's for sure. So for a lot of people, used to be charity in church and things like that, tithing was above the line before you got down to looking at your standard deduction was, and so you got to take those off, but not anymore. So what I'm saying is if you're a single person, and let's say you're retired, at $15,000 is basically your standard marital deduction. If you're married, it's double that. It's $30,000. Unless you're giving more to charity and stuff than that, it does you no good tax-wise. So for a lot of people out there, I know that they give more than that, and they can get the benefit of claiming those deductions. And by the way, I will say that charitable deductions, not that anybody would go this high, but they might, up to 50% of your income is tax deductible.
What about RMDs? I always think about RMDs at the end of the year. What do we need to know about that?
Sure. Required minimum distributions are what you have to take once you hit the RMD age. That used to be 70 and a half a long time ago. Now it's actually 73 and probably going to progress unless Congress changes things to 74 or 75 before you have to take, when I say have to, it's mandatory that you take your distribution from your IRA. Now, the thing to think about here is, let's say you have a pretty massive IRA and you really don't need the money, yet you have to take an RMD, and you know that. You can do what's called a QCD, a qualified charitable distribution, that allows you to circumvent the taxes on that up to around $100,000, and it never shows up on your tax rolls because you'll pay it directly from your IRA to the charity, and we do quite a bit of that with people around. So it's one good way to keep yourself on a lower tax bracket and not have to go through the gyrations of a really complex, potentially, tax return.
And if you love your CPA, if you love your tax preparer, do yourself and them a favor. Around October, November, go ahead and organize your tax documents. If you've got receipts, pull them out during a slow time. Put them in envelopes. You'd want to maybe label what those envelopes are to make it easy. Any 1099s, W-2s, any other important tax documents that your tax preparer may want to see. Get those in order before the end of the year. Of course, we always want to take a look at our investment performance, review debt and loan repayments, but also end of the year is probably a pretty good time to maybe take a look at where you've been and make some new financial resolutions. Jake and Randy?
Absolutely. I think that all of us can benefit from looking back over our shoulder and see what we did and think about it a little bit and go, probably should have done that a little bit differently.
That's right. The old saying, hindsight is 20/20. So
that's right.
That's what we want to do here at the end of the year. Hope that people have enjoyed our conversation about things that we want to do here at the beginning of the year, at the end of the year, that will make your life easier as we get into retirement. Again, if our listeners want to know more about this, if you need some help in organizing your finances, you want to see whether or not you're on the straightest path towards retirement, you want somebody to take a look at what you've got, call us here at Floyd Financial Group and schedule your no-cost, no-obligation, no-judgment financial review by calling 417-889-7233. Not going to cost you a dime. 417-889-7233. You can make the call right now. Just leave your name, telephone number. Lovely Ashley will call you back during the week, and she'll set up a time that is convenient for you and the boys here at Floyd Financial Group. So take advantage of the opportunity. We're reaching out to give you a helping hand. Reach back and take it. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about cash flow versus income and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about cash flow and income, which sound like they might be the same thing. But let me tell you, if you were a benefactor of USAID or one of those people that indirectly was a benefactor thereof, you may want to rethink that, because I think some of your income may be going down, so you may need to adjust your cash flow out.
If your name is Hillary Clinton, you're going to be getting less money.
Jake, I love that you chime in there every once in a while with a voice of reason. Cash flow versus income, though, I mean, when you're planning for retirement, one of the most fundamental financial considerations is whether cash flow or income holds greater importance for you. So let's start off by talking about why income in retirement is important, and then we'll put cash flow up next to that and decide which is more important. So let's talk a little bit about income, the sources of income to begin with.
I think it's important that people know that, we realize when you come in here and you still are working and you're getting ready to retire, that you've never taken, or most likely most people have never taken income out of their retirement assets. And so it's kind of a new concept, and it's something that you have to think about a little bit. In fact, I'll never forget when my sister retired. She was married to an orthodontist, and they were really very well-to-do and ended up pretty wealthy. And we put her on her retirement income, which was a very good number. She said, I want a fixed income. and she was just about in tears because she was not used to that, She just was used to having unlimited, because she had all that money coming in all the time.
Yeah.
So income is important, and we realize that is something that is very, very important to plan for, because I don't know about you, Jeff, around my house, even though today I have a lower number of bills that come in, they still come in about every 30 days.
That's exactly right. They come in and I've got to pay them every 30 days. Maybe insurance or car insurance or something like that. I can pay that every 6 months or every year. But yeah, the rest of those bills do come in every 30 days, and I got to have some income in order to pay those. So the sources of income for most people, Social Security, I guess, makes up 35 or 40% of their income. And that's going to be pretty fixed there. I mean, it's going to go up a little bit with cost of living increases. If you've got pensions, traditional pensions offer a fixed income for life. And then there are things called annuities. So talk a little bit about annuities and why some people love them and why some people hate them and why they may or may not be a good source of income in retirement.
Right. The one thing I want to say about Social Security that I heard here recently, that there's apparently like 1.5 million 112-year-olds still collecting Social Security that are obviously most likely deceased, because
oh my gosh. Yeah.
How many 112-year-olds do you know? I was watching Senator Kennedy from Louisiana talk about these numbers, and he said, I don't know about you guys, he said, but I've been trying to track this, and it seems like around the world there's only about 40 people north of 112. And I would just say this, that I'm sure that would be those people's only source of income. Social Security.
As Elon has gone through a lot of this stuff, he's like, one of the things he uncovered the other day was that there's no deduplication aspect to Social Security, meaning if the system shows that there is two of the same payment going to the same person, there's no framework for that to be fixed.
Right.
And he said, as a result, there's a lot of these that are going out more than once, which obviously would be a great way for certain members of Congress to line their pockets or send money, divert money to where they want it to go versus where other people. I mean, we know that Social Security, when it was set up, you're supposed to get it at 65.
Yeah.
And the life expectancy at the time was 67. So we know that Congress planned from the very beginning to use this as a slush fund.
Mm-hmm.
I mean, that's not a surprise. That's not really even up for debate. I mean, it is what it is. The difference is now we're going to have some accountability for the first time. And I know that's not what we're talking about here, Jeff. We got sidetracked. I'm jumping on my soapbox here.
That's okay.
But back to Social Security, it is definitely a major source for most people of income. In fact, we have lots of people that don't have any pension, and it's just Social Security and whatever they take out of their retirement accounts. And so some people can make that work. Some people can't make that work. I think a lot of it is the lifestyle you're accustomed to living plays a big role into whether or not that's going to be a problem. But I do think that, with a little bit of planning, just about anybody can see their way to retirement at some point.
Yeah, I also think industry-wide, Jeff, there's been this, if you say, how do you maximize Social Security? Well, you work till you're 70. Yes, everybody knows that. Okay. When should we take Social Security? Well, numerically, you should wait till age 70. Well, you know what? There's the financial side of things, then there's the practical side of things, and then there's the emotional side of things. And so when people ask me for that answer, I tell them, that just depends on you and your specific situation.
Sure.
Can it be right to take it at 62? It absolutely can. Can it be right to take it at 70? It absolutely can. But somewhere probably in the middle is where most people live. And so, Social Security, great source of income, a good baseline for sure.
But people getting close to retirement, Randy, I would say this is probably like the number one thing that we talk about is when should we file for Social Security? And it is a relatively simple question. The answer is not always so simple, but that is something that we help people work through in here every single day. That's probably the biggest question we get asked. So we'll help you work through that too when you come in for a consultation.
Well, my aunt took Social Security at age 70, but she worked until she was 90 in a retail store. She's 107 now, and her only income is Social Security, so she certainly has gotten her money's worth out of that, and she's probably the reason why Social Security is maybe not in as good a shape as it could be. So the importance of income in retirement, of course, we talked about Social Security, pensions, and I'll get back to that original question.
Sure.
Do you think that annuities should be considered a major source of income in retirement? How should we use annuities? Some people don't like them. Some people love them.
Yeah. So I think the headline here, the thing to think about is through an annuity contract, let's back up and let's talk about pensions for a minute. What is a pension? So a pension is where a company or a government or a municipality has set aside a certain amount of money over your lifetime that when you hit a certain age, you go ahead and get to draw off that forever. Now, it's not like that money's stacked up over in a corner with just your name on it so that we know there's an unlimited supply of money out there for no matter how long you live. That is not how that works. It's money that's invested mainly conservatively in most pension plans, so that using a combination of your life expectancy and a return on investment, they're not going to deplete that fund. Now, annuities for the individual outside of a government or a municipality is a way for you to personally set up a pension of your own, where you can have some guarantees of income is one of the things that an annuity contract will do. Now, it can do that immediately once you retire and just start paying you and promise to pay you and your wife for the rest of your life. Or you can set these up a little bit early and have them keep deferring your taxes and things and growing your balance so that your income will go up as the future comes along. There's many different types of annuities. I would tell you that probably in today's world, the annuity contracts that are out there, and it is a contract. It's a contract between you and the insurance company. They promise to do certain things. Some people say, I hate insurance companies. In many ways, I can agree with you, like on some of the things that happen with health insurance, but I will tell you on an annuity contract, those companies will do exactly what they say they will do.
Yeah.
The important thing is that we as the client understand exactly what that is. And we match those and marry those things to suit each individual person. So can they be a good part of an overall retirement portfolio? Absolutely they can. We just have to make sure that we pick the right one for the right client.
So the good sources of income that we talked about here, Social Security, pensions, annuities, and I'm going to add investment dividends and interest. You can get those from stocks and bonds, mutual funds. They can generate regular income through interest payments and dividends and really supplement the other sources of income. So that is your income. I want to talk a little bit about cash flow now. Income is the money coming out, but cash flow is not only the money coming in, but it's also the money going out. So here's the big question, guys. Which is more important, the money coming in or the money going out?
Cash flow is king, Jeff. Right. And especially when you get to retirement, it becomes less about income and more about outgo. In a lot of ways, if you come to me and say, is it better to make another $1,000 a month or reduce spending by $1,000 a month, like paying off a mortgage or something like that? Pretty much categorically, if you spend less, it's better than making more from a tax perspective and from a health insurance perspective, potentially, depending on whether we're talking about Obamacare or IRMA with Medicare and that kind of thing. A lot of people find that it's not that you need less money in retirement. It's that you need less income to get to the same level of spending in retirement because you're paying less in taxes, you're paying less Social Security tax, you're not paying FICA, you're not paying workers' comp and all this other stuff because you're not working anymore. And so all those things add up to quite a bit. You might be surprised how little income you actually need in retirement, especially if your bills are relatively under control at the point of retirement.
That's right. Also, a lot of people are funding 6, 8, 10%, in some cases more, into their retirement plan. So you'd put that on top of the 7.65 you pay for Social Security, Medicare, Medicaid, plus the taxes you're paying on the higher income, plus that. All of a sudden, what you bring home is very different than your gross number. So we always ask people, hey, what's your net that comes in? Do you get paid once a week, once a month, every other week, every 14 days, so that we can really get a grasp on what people are really spending? And of course, we always look at budgets and what they're going to need in retirement as well.
If you have trouble, though, coming up with a budget, a good starting place is your take-home income, and then add back in the cost of healthcare. That's a good starting point because that is what you're actually spending, right? Now, if you're amassing a couple $100,000 in your checking account, then obviously you're not spending it all. But for the most part, a net paycheck and then add back in the cost of insurance is a good starting place for a budget if you don't know where to start.
Well, I will repeat my wise saying that was taught to me many, many years ago. Remember this, ladies and gentlemen, when your outgo exceeds your income, your upkeep becomes your downfall. So we have determined, I think, that cash flow is more important than income in retirement, but certainly both of those are important. If you'd like to talk about cash flow or you'd like to talk about income, Social Security maximization, anything, give us a call here at Floyd Financial Group. Set up your no-cost, no-obligation, no-judgment retirement review at 417-889-7233. You can make that call right now. Leave your name, telephone number. Ashley will call you back during the week and set up a time for that appointment. Again, no cost, no obligation. It's just a casual conversation. You don't need to dress up for this. You don't need to bring your checkbook. Certainly, we're not going to charge you anything. You don't need to bring your tax returns at this initial consultation. It's sort of like dating. We're going to ask you a few questions, and you'll ask us a few questions and see whether or not we want to continue this relationship. But again, there is no cost and no obligation. 417-889-7233. Make that call and check us out online at FloydFinancialGroup.com. Time for a break, Randy and Jake. When we come back, we're going to be talking about investment strategies for retirement, not running out of money, when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about investment strategies for retirement.
And when we were working, we had an investment strategy to get to retirement, but now we're in retirement. So I guess the first question, Randy and Jake, is once we're in retirement, should we continue to invest the way that we did before we got to retirement?
Well, that would depend on how you were investing before you got there. But again, you're right. We need to be re-looking at the last 5 years or so before retirement. We need to be really watching what we're doing more closely than ever. We need to watch all the way through, obviously, but
Sure.
We really need to look at what's our strategy, what's going on in the world, because those last 5 years or so can be very crucial as to what you're able to do in retirement or not, and how you react to what's going on, like I said, with taxes, with regulation, with public sentiment, with who's blowing up who, and all these different things around the world play a factor in how we invest money. So everybody needs a good blend, if you will. You probably need some stocks, you need some bonds, you may need an annuity contract, you need some savings, you need an emergency fund. All those things are part of your investment portfolio and need to be balanced out. But there's an old rule out there called the rule of 100, and it basically says this, take your age from 100, and whatever that number is the amount of money that you should have in conservative investments, things like bonds and maybe interest-bearing accounts and maybe even annuity contracts, that sort of thing. So if you're 65, that would be 35% needs to be safe, 35% should be stocks, 65 should be safe, because again, when do you get a chance to go back and redo your life? You don't get to, and who would want to? I don't know if I'd want to go back and start all over again.
Oh, gosh, no.
Try to do it again.
That rule is kind of a guideline.
Right.
There's certainly people that need to have different allocations than what that dictates, but it is a little bit of a rule of thumb if you're wondering whether you're too aggressive or too safe. You can get kind of
Yeah,
insight from that.
I'm with you, Jake. I mean, I know that here we talk about it from time to time. It's not something that we just, that's it. That's how we go in and build plans.
I think maybe it should be take your age from 100, then add 10. And then you're probably a little bit closer. If you're 65, only having 35% of your money in more growth assets might be a little light, but having 45 or 50% might be in the ballpark. But anyway, long story short, too late, right?
No, actually, I think one thing I'd like to add, though, it's different about the generation before us boomers.
Mm-hmm.
They were more stable in their retirement goals and wishes, and that was, just to be able to live a normal life. Now, us boomers, we're spoiled rotten.
Oh, yeah.
We want to have our cake, maybe 2 cakes, and eat it too.
Oh yeah. And a hot fudge sundae and a cheesecake. We want it all. It was, are you kidding? Your TV's only 60, mine's 80 inches wide. I understand, because my aunts and uncles, parents and so forth, they had a rather simple retirement. All they wanted to do was to stop working. But, back in those days, they had one of those newfangled colored TVs, and my uncle had a little boat, stuff like that. He loved to fish. As a matter of fact, on his gravestone today, there's a fishing boat and a guy fishing on that. And they were as happy as they could be. But today, it is a different story. And people need so much more today, it seems, to be happy. And I think that's a bad thing. We're looking for happiness in things like 80-inch TVs and how many, different gadgets and doodads that we can have.
I don't think 80 inches will make you happy. You need at least 86.
86, okay, I gotcha.
Also, back in the day, we had 14-inch semi-V aluminum boats with an 18-horse Evinrude.
Oh, yeah.
And today, you have a 21.5-foot bass boat with a 400-horse
That's right.
outboard on the back.
400 horses on a bass boat. Yeah, I mean, my uncle had a boat. It was a wooden boat. I don't know if he made it or not. He had a boat shop, and he would make, wooden things. But, yeah, that wooden boat, and it was varnished, and he used to tow that thing up to Minnesota and back and fish on the lakes there in Ohio in the southeast, and, had a great time. My aunt, she had a part-time job at the department store and was in a bowling league. It's a whole different ball game than it is today. So, anyway, we got off on a little bit of a tangent there. Investment strategies for retirement, and a good mix of investment strategies helps balance growth and stability. Equities and stocks, bonds and fixed income here, cash and short-term investments. Having these investments in retirement, I would think as well, too, is a pretty good way to not run out of money.
Absolutely. So I think probably one of the biggest things for everybody is your investment portfolio will shift over time and as you're invested, for sure. There's just no two ways about that. So I think it's important that you have a regular review process that you go through, and somebody that you trust to kind of sit down and tell you the truth. I mean, and sometimes, we have to tighten our belts a little bit when things are not good, when we have a 2007, 8, or 9, or if we have a .com bubble type event again, or a COVID-19 or Black Monday, whatever it may be. You need someone that's going to sit down with you, be in the know about what's happening, and help guide you through that process. And I think that that's really, so the bucket strategy works well. You got a short, mid, and long-term goal. That's fine. But if you're not one of those people that has more money than you're probably going to ever need, and you need to milk the most out of your retirement situation, that may not be something that works for you. You may need a slightly different approach to retirement income.
So we've determined that investing in retirement is important. We need to determine what sort of investments, and as you get older in retirement, maybe those investment choices would change to be safer investments. Okay, so let's talk about the withdrawal of those investments as we get into retirement. Of course, if you're not looking to leave money to heirs, you maybe want to figure out a way to withdraw it all. The 4% rule, everybody has heard about that. Would you say that that is just more of a guideline and really not a rule?
Yeah, it's a guideline for sure, not necessarily a rule, because that guideline, I mean, if all of a sudden next week interest rates are 10% and I can go out and buy 5-year 10%, CDs, I can probably change my guideline on the 4% rule.
And frankly, you'll probably need to, because inflation's going to the moon.
That's right. So there's a lot of moving parts there, but I think it's important to understand what the 4% rule is and how the adjustment for inflation works, because I have people confused on this sometimes. So if I've got $1 million and I go out there and I pull by 4%, that's $40,000. Let's say that inflation next year is 3%. Well, 3% of $40,000 is $1,200.
Mm-hmm.
A lot of people think, so I go to 7% next year? No. You go to 4.6%. 3% next year, or 4.12 actually is what you would go to. 41,200, you go to 4.12 in a 3% inflation world. So you get 41,200 rather than 40,000 that you started with. So it doesn't really ramp up, just big time like some people think it's going to. Oh, if inflation's 3, I'm going to get 50,000 next year, right? Well, no, not quite. 41,200 is where you would go to. So it's one of those things too that depending on your risk tolerance, how much money you have, your ability to accept and want to take risks varies greatly amongst people, and how much money they can actually take out and withdraw. And then again, like you said, I have people come in and say, hey, I'll do anything that I have to do to leave my kids $1 million in retirement, or $2 million, whatever that number is. And then I have some people say, I want my last check to bounce. So
yeah, I like that last one there too. These kids are living higher on the hog than I ever did. There's another saying, well, higher on the hog. What does that actually mean? We're going to do a show to explain some of these things. But you were in the food business. What does it mean, higher on the hog?
So think about it. So the higher you get on the hog, the more pricey the meat. So the tenderloins are up in the middle of the back. The best ham comes right off the top of those butt cheeks back there. And
yeah,
I had no idea what that meant. It makes total sense.
Yeah.
But I never knew that's what that meant.
High on the hog rather than down there where the belly drags, right?
That's right.
I do like me some bacon, though.
I do too. I'm a fan of good bacon.
There you go. Anyway, these are the things that people can't hear in the other radio shows, guys. So listen, you're listening to Show Me the Money. You get more than just financial advice. You get the source of all of these little euphemisms here, too. Okay, so let's wrap it up by talking about a withdrawal strategy. I've got taxable accounts. I've got tax-deferred accounts. I've got a Roth IRA. In what order should we make those withdrawals?
Yeah, that's a good question. So, I had a gentleman sitting in my office just yesterday that asked me that exact question. He says, how do I make sure that I'm being as tax efficient as possible? So everybody's situation is different. And when we come in, depending on when you start to plan, if you retired yesterday and you come see me and you have all IRA money, that's pretty hard to do much tax planning at that point. If you have a lot of IRA money, you come to see me 5 years in advance, maybe 10 years in advance, and you're looking at really maximizing tax efficiency, we may want to talk about converting some money to a Roth IRA. If you have brokerage accounts, if you have IRAs, you have Roth IRAs, and you have muni bonds, and you have all these different things have different tax methods applied to them. So to give you the exact remedy for that, I don't know that I can do that on this program. Everybody's situation is so different. And again, depending on what your idea would be for leaving your family, do you want to pay more taxes during your lifetime so they can pay less, or do you want to pay less during your lifetime so they can pay more? Knowing that they're going to have, if it's IRA money at this point, 10 years to mitigate those taxes because they can take those out over 10 years of withdrawals and mitigate taxes that way. I'd like to give you a definitive answer, but I'm just going to tell you, Jeff, there is no definitive answer on that, and that's why, again, Jake and I we like doing this, and it's what gives us a job.
Right. You got a job doing that. Well, if our listeners have questions about investment and withdrawal strategies, really anything we talked about on the show today, remember, give us a call right now this weekend, 417-889-7233, and request your appointment to sit down with Randy and Jake. We would love to meet you. No cost, no obligation, no judgment. 417-889-7233. Our website is FloydFinancialGroup.com. Well, Randy and Jake, I love talking to you guys, but the time says we got to get out of here. So for Randy and Jake, I'm Jeff Shade. Have yourself a great weekend. Thank you so much for making us part of your weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is